Stocktake is brought to you by Intelligent Investor, Australia's leading value investing research house. Get your free trial by heading to intelligentinvestor.com.au. The information in this podcast is current on the day of recording. It is general advice only, does not take your personal situation into account, and may not be suitable for you.
Good morning, everybody. My name is John Addis. I'm the founder and editor of Intelligent Investor, and welcome to the first episode of Stocktake for the year. Nick is joining me today and Gaurav. So the first thing we're going to kick off with for the year is a little quiz. So in 1993, how much money was invested in US ETFs and index funds? And Nick's the expert on the US, so Nick's got to answer that. How much money was invested in US ETFs and index funds in 1993?
I genuinely have no idea. You sort of stuck me.
Have a guess.
I'm going to go with $5 billion.
Not bad. 23 billion.
Okay.
No. Gaurav, guess how much is invested in those two things at the end of 2024?
Oh, it'd be in the trillions.
It's 10 trillion.
Yeah.
10 trillion. So over 50% of total equity fund assets are now in passive funds.
Over 50%.
Over 50%. And this has an incredible sort of concentration effect on the biggest stocks. And also, I think there's a lot of academic research out there that says that it exaggerates market upswings. So what do you guys think of that position? Is this one of the reasons why it is hard to find buy recommendations right now?
You know, I always thought that, and I've said this for a while, that the growth of passive should make active investing easier. And I thought that because you have a growing pool of unthinking money that just mindlessly buys and sells according to weights and indexes and automated rules. And whenever you have mindless buying and selling, there's an opportunity for the thoughtful investor to make excess returns. I've always thought that. I'm not so sure about that anymore because the sheer volume of money, I mean, that you just mentioned that important number there, over 50% is passive investments. The sheer weight of that just drives individual stock prices more than fundamentals do. And I think that the difficulty there for the active investor is trying to navigate these very elongated cycles psychologically. So I've just seen so many people get frustrated with share prices and valuations, and why don't the fundamentals meet the valuations? Because over time, that's what we've been trained to believe, and it's been years and years, and that has not been the case. So it might actually make it harder.
Nick, what do you think of that view?
Yeah, I agree a little bit. What I'd just caution is ETFs are definitely a factor, as you said, 50% of the market, and it is money that just buys it just based on index weights. So it's not doing any of the intrinsic value work that an active manager might be doing. But at the same time, the strong performance over the last 2 years has really been to do with earnings. Like it's not just that these companies aren't growing or earnings aren't improving. If that was the case, but the markets were rallying very strongly, I'd probably agree more. But I think it still comes down to the fundamentals. But ETFs, as you said, John, just exaggerate those moves. But I think the moves, the rationale for the moves are correct in the first place. Just the same as in 2022 when the S&P fell 20%, that was because earnings fell and earnings expectations for 23 and 24 were lower. But yeah, it's a tricky one.
I think the difference in responses there from Nick and I reflect the fact that Nick looks mostly at the American markets, where I think, Nick, your comment is true. And I look mostly at Australian markets, where I think there's been a lot more PE expansion than there has been earnings growth for those top 20 stocks. Very hard to find earnings growth in those top 20 stocks. So but
even though, I mean, Nick would know this better than me, but stocks like Costco, Spotify, other kinds of companies are trading on twice the historical multiples and are still only growing earnings at 3 or 4% a year.
Yeah, and that's true. And I agree with you, Gaurav. Like something like Commonwealth Bank on 27 times is.
It's not just Combank. We can roll off the list. Long list of companies.
I just use that as the poster child, just because
it deserves
so
to be.
far out of it.
Poster child. Yeah,
and it's the biggest stock. But John's right. Costco and these other businesses that were once trading at sort of a 30 to 35 times multiple, and now at 50 to 55 times, or even 60 times, and their earnings growth has not changed. If anything, it's probably their potential's fallen away a bit as the companies have grown. But I don't think this is ETF specific. Like we had the Nifty 50 back 50 years ago. Right. So it's not just that this is a strange period of perhaps overvaluation, but I don't know if it's specific to ETFs.
But ETFs help because I think what they do is they provide that initial drive of share prices, and then that's what brings in the herd. And you're definitely seeing herding into a bit more than a handful, but you're seeing a herding into a small group of stocks, and that has been driven by a combination of ETFs and then sheep investors. But it starts off with the passive funds pushing prices higher, and then higher prices seem to attract momentum and other investors as well.
Yeah, it seems to be an accelerant. And the interesting thing is that we always think that the accelerant is always up. But I think you mentioned 2022, but you could go back to 2020 when we had that 23% fall on the ASX, but also on the S&P 500 in the space of 2 weeks. And Wall Street circuit breakers were implemented then. And I imagine that was because you get the accelerant effect working on the way down as well as the way up. And there's research to support that. There's a Bank of International Settlements report that says that this is an accelerant and it is going to exaggerate market swings. And it seems to be quite well sort of academically substantiated. But I suppose the problem that we've got is that these cycles are now becoming elongated, and this poses psychological challenges for people like us who want to buy value and are finding it very, very hard to get hold of. So at that point, we're going to take our first break, and we're going to come back to that issue after we've heard a word from our sponsor.
Think investing is out of reach? Think again. Fund Later lets you own a $10,000 portfolio with just $4,000 up front. Fund Later will lend you the $6,000 to fast-track your investment journey, and you can repay it in monthly installments that include a facility fee. There's no waiting, no margin calls, and no interest, and you can choose from 3 professionally managed portfolios. And here's a bonus. Open and fund a Fund Later account in January or February, and you'll get free access to InvestSmart's online bootcamp course, valued at $99, to sharpen your financial skills. Start investing smarter and faster this year. Visit fundlater.com.au to learn more. Terms and conditions apply.
So we're in this period where it's hard to find value. Prices are rising across the board, sometimes to ridiculous levels, and our buy list is quite short. And we've suffered underperformance, not just in the funds that we manage, but also in our own personal portfolios. I think we've all underperformed. Now, in value investing, you get these periods. It happens. We're all used to it. But some listeners might not be. What do you do in these times?
So I think when I go through a period of underperformance, it's important to just take a step back and first think about your goal. So what are you trying to achieve with managing your own money or your own assets? For some people, that goal might be to beat the ASX 200. I personally think that's a terrible goal. For retirees, it might be to maintain the same super balance as they had last year and use some of that income to live off. So everyone has a different goal. So once you define your goal, you can actually measure your performance to work out if you're underperforming or outperforming. But personally, I like to revisit all my investment thesis, particularly the stocks that are underperforming, go back and see if anything's changed. Am I still confident with that thesis? And then try and work out if something's changed. If my thesis has changed, and I don't think that stock is, that position is what I thought it was, then I'm happy to sell that position. But sometimes it's just bad luck. and I don't want to change my overall strategy. Maybe management left unexpectedly. Sometimes it's actually just bad allocation. Maybe 7 out of 10 stocks in your portfolio went up, but the 3 that went down are much higher weights and your performance is poor. So now you have to revisit that. And then finally, which is usually the case, or hopefully the case, is sometimes it's this patience and time, and you have to be willing to accept periods of underperformance if you want to get significant outperformance long term. Every investor goes through it. Doesn't matter how good or great they are, they always have periods of underperformance. I think Buffett's underperformed like 35% of the time over the last 43 years against the S&P 500, and he's widely considered the greatest investor. So you have to be willing to stomach underperformance. And for me, this goes back to looking at what my investment case is and making sure I'm still comfortable with it.
Yeah. I would say that if you're outperforming for decades, every single year, for decades, you're running a fraud.
Yeah, I agree with that.
Yeah.
You're Bernie
exactly
Madoff.
Right.
Yeah. What about you, Gaurav?
There are 2 important points that Nick raised that I just want to expand on. First of all was this idea that the price of outperformance in the long term is underperformance in the short term. We should put that on your wall, put it on a T-shirt. You must accept that. Now, they're not just words. It's easy to kind of say the words, but when you're living the underperformance, that's when it gets tricky. But we must understand that and accept that is true. That's taken me a long time to accept, but over sort of 20 years or so, I think I'm there, and I get that and I accept that. And that's the right kind of patience. There's a wrong kind of patience in investing, but accepting periods of underperformance is the right kind of patience. I think the other good point Nick raised was just about your objectives as well. Trying to beat the market, I'm a bit more sympathetic to that view, because I think the alternate to you running your own money is to just put it in a passive vehicle. And so you want to be testing over a period of time whether you can actually do better as an active investor than you would as a passive investor. So from year to year, you don't really want to put too much emphasis on performance versus the passive alternative. But over, say, a 5-year period, if you're still underperforming the passive alternative, then maybe you should consider whether active investing is for you. What you actually do on a sort of an annual basis with the stocks that are underperforming, I actually like to have little triggers in place. So what do I need to see, or have a mental model in my mind about at what stage would I be willing to sell that position? What do I need to see to sell that position? How bad do things have to get before I sell? So now I want a trigger point for selling, and when that trigger points hits you want to kind of sell. So you want to identify thesis breakers up front, and the reason to do that is you want to remove roadblocks to decision making. I want to automate some decisions rather than being clouded by emotion, and that's one way of doing that. So I have these automatic sell triggers, and once they kind of hit, I just sell, and then I re-examine the thesis again. It's much easier looking at a stock once you're free of the obligation to hold it, rather than trying to decide what to do with it when you're already a holder. So that's one thing I'd recommend. That's why I'm not that keen on this strategy of sort of buying small bits of companies and then watching how they go. I do like to do my work up front, and then if I'm happy about the investment, I'll then buy an investable chunk of it rather than buying nibbles. And then I think that impacts my psychology, and then I'm already more favorably disposed if I already own it. I know that bias about myself. But you need to identify.
Owning a bit of it, though, is an incentive to actually understand it more.
Well, for some people, that's true. You just have to understand what your own biases are and work with those. Because the psychological part of investing is really important, and everyone's psychology is different. So it all starts with knowing what your own biases are and how you respond to different events.
Well, let's dig into that a little bit, because we're in a period now where the dumb money is doing really, really well. And I mean, that sounds a terrible way to put it, but I think that's true. I'm not saying the people are dumb, but it is dumb money.
Strategies.
They're just following stuff that's going up. And, some people can make money out of that. I don't feel as though it's a long-term way to do well. But when you've got people who are, the guy who sort of mows your lawn, or somebody comes around to fix your lights and they're going on about how much money they've made out of Bitcoin, it's easy to say you've got to be patient and you've got to be, sit tight and stay still and all the rest of it and do nothing. But it's really bloody difficult. When everybody around you is making money and you're meant to be the expert and you're not. So what is it that you guys do to actually stay sane during these periods, like practical things that listeners can do to stay a bit more sane than what they might feel at the moment?
I don't know how practical this is, but I like to remind myself, if people are making large amounts of money very, very quickly, that isn't investing, that's gambling. It's if you're investing in a meme coin that the highest elected officials just released, that's gambling. It's not, it's not investing. And again, it sort of comes back to my point about what's your objective. And if you have a clear objective, then I find that you're not as persuaded to go for these, make short-term sort of money-making opportunities that you see this plastered over social media or anything like that. But I just try and remind myself it's gambling, not investing.
Gaurav, what about you?
I always, I think stories are really important at these moments, right? I heard this story about, I think it's Howard Marks. He tells a couple of great tales. One is the tale of a guy who ran through a firework factory holding a lit match, and when he got to the end, declared himself a genius, declared himself a daredevil. Look, I got through. But that doesn't mean running through a firework factory with a lit match is a smart thing to do, even though if you get to the other side alive. The role of luck and chance, we don't give that enough respect. There is so much of our returns are based on luck and chance, and understanding what is smart and what is lucky, even if you're on the whatever side you land on that on the outcome is really important. So I'm always very aware of the guy who is at the end of the runway with a lit match. I think I'm comfortable calling that person an idiot, even though they may be rich or maybe they've done very well. The process
it's a dumb thing to run through a fireworks factory with a lit match, right?
Buying a Trump meme coin, even though you've made 10x your money in 2 days, is a stupid thing to do. I saw on Twitter the other day, someone sent me a caption of someone I don't know who was, someone saying that the office cleaning lady had just made $200,000 buying a meme coin in 2 days. And I just think that's stupid. I'm not impressed with that. I'm not envious of that. I just think it's stupid. And I think keeping your eye on what you're trying to do over the long term. I'm running a portfolio here. My entire family wealth is tied up in it. I'm not going to do something stupid. And no matter what, just because someone else does something dumb. But I think that's really the test of your investing guts, or your investing North Star. Are you willing to do something stupid for a return?
And I think if you're young, so I know a lot of people my kids' friends who invest in crypto. There's one who turned $2,000 into $400,000 in the last crypto boom. I pleaded with him to sell half and just put it in the bank, but he didn't. He was what do they call it? Golden hands or diamond hands. We're going to go all the way down as well as all the way up. Yeah. And it kind of devastated him. So I think if you're young and you make a lot of money, then do something sensible with it and pull it out and put it in the bank. Don't ride this all the way up because it will crash ultimately and you don't want to be there when it does. But if you're just messing around with $2,000 or $3,000, then I think it's fine, because one of the things that I think you need to have when you get to this kind of point in the cycle is experience. And if you can get that experience for $2,000 rather than 20 or 200, and you see things blow up, and you learn some of the signals, about where we are in the cycle, that experience is really, really valuable. So if you've had some history, this period is a lot easier to endure. And I would just take people back to those moments where they've seen all of this before, remember how it ended, and then think that it's probably going to go the same way at some point. And that allows you to be a little bit more patient. The other thing that I do is I just make sure I get away from watching this stuff all the time.
Yeah, that's a good
because
idea.
Because it can really suck you in. So I tend not to read the news. I obviously read the business press. But, the stories about what you mentioned there, just Gaurav, and just stay away from that kind of stuff. And that allows you to stay a little bit more grounded, I suppose is the word. And that enables patience. So have history, have the experience, try not to lose money too much in gaining that experience, but don't get sucked into the news media cycle and the friends that are telling you need to be in this and you need to be in that because I've made all this money out of it.
That's a great indication of where we are in the cycle. I actually think we're close. We're close now. This is this is getting.
It's a great point about just pay. Like in anything, you just need to pay to get an education, and if you can pay as little as possible to get those, to get that education.
I went to Coventry Polytechnic, mate. It doesn't get any cheaper. So, to our third topic, where are some pockets in the market that are interesting right now? Because we do want to invest. we do want to look for buys, and normally when you have a boom cycle like this, there are places, areas, sectors that get left behind. Can we talk about what those sectors are? What's attracting you right now?
Yeah, so the ideas that are really interesting me at the moment are probably some of those COVID beneficiaries. They've done quite well. So one was like IT distribution. Another was the sort of bioprocessing and a lot of healthcare stocks.
Mm-hmm.
They haven't participated in this rally at all over the last 2 years, and they've actually fallen, particularly in 2024. So we released a new buy idea on CDW to start the year, and that's an IT distributor in the United States that, after years of growing at sort of that mid-single to high single-digit range, their growth exploded in COVID and now has fallen. But I think IT distribution and just the growth of IT long term will happen. It's just been delayed. So they're sort of the pockets I'm looking at, but they are getting harder to find. The other one is just on a broad regional basis. The UK still looks cheap, particularly like UK. Sorry,
but you've been
UK
there lately.
listed.
You would understand why that is, Nick, right?
Yeah,
London as well.
Yeah,
everybody goes to London and go, "This place is fine," but no, well, just leave. Get 100 miles away.
Yeah, that's it. But particularly the UK listed stocks that have sort of more global operations.
Yes, that's right.
They trade very cheaply compared to their overseas peers, and they're still quality businesses. So that just broadly is another area that I'm interested in.
I would say, from my point of view, answering my own question, was that you look in areas where people aren't.
Yeah,
because in these, you do the opposite of what everybody else is doing. It is a contrarian perspective. It doesn't mean you'll be right, but there's a kind of sexiness to growth. There's a sexiness to anything to do with AI. Go and look at people who make paint. Go and look at people who rent out offices, or maybe not offices. Let's not do that one. Something that is kind of boring, like selling cars, or just run-of-the-mill stuff that people just are not interested in. And that is often where you find sort of reasonable value, maybe even good value, because there are pockets in the market that just get left behind at times like this, and that's normally where you find some interesting stuff.
Yeah, that's a good approach to answering that question. You start with where is the crowd focused and where is the overvaluation, and that's really easy to spot, right? There's probably 20 stocks that are just every investor is crowded into them, and we all know those names. We talk about them all the time. Those software businesses, all these high growth businesses on the ASX, they are crazy valuations, even though they're outstanding quality companies. And the opportunity comes from neglect, and the neglectful parts of the business of the market are slower growth, boring businesses that often pay very high dividends. Quality of the businesses is still excellent. But even though they're not growing very much, the prices are so attractive that I think they'll make really good investments over the next 10 years or so. That's certainly where I've been putting my money, John. And I think if you look through our buy list, you'll see a pattern of stocks that sort of fit that description nicely.
Yeah. Like if all the people talking about Bitcoin and crypto and gold right now haven't heard of these companies and look at you and go, what? As though
why would you buy that?
Some odd. That's probably a good sign. Okay, to our last segment then. And this is a bit of a curly one because in times like this where we are being patient and we're just waiting, and we do face maybe an exaggerated cycle, which means that we might have to be patient for longer than we'd like. We know the stocks that we'd like to buy. We've got a good handle on the quality businesses on the ASX that we want to own. We've got a price that we'd like to pay for it. We're just playing this waiting game now. And this is a difficult question to answer, but I'm going to ask it anyway, because I think people will be interested to know what you guys think might be the triggers for a market fall. Now, I know Angus has gone on about a third world war. I don't really want to talk about that. It's just depressing, and I think it's a very low probability event. But, we've seen in the past there were random things that you might not expect, like COVID. But what tends to happen at this point in the cycle when you've got extreme valuations, you've got people who are bearish, who are flipping and going bullish, where does the crack in the wall appear?
Well, you've got points of near universal optimism, John. So almost by definition, the weakness, the crack, the catalyst is going to be unforeseeable. But I actually think it's going to be something small. I don't think it's going to be something big like COVID. Often in points of maximum optimism, it only takes a small change to affect momentum, and then that momentum
Donald
turns
Trump
the other way.
stubbing his toe or something.
Could be someone sneezing 7 times or something like that. But I don't think I'm not looking for something big here. I think it's going to be something really small. It changes momentum, and that momentum then goes into reverse. And all the glory of passive funds pushing up prices that we've seen over the last 5 years, imagine that in the other direction. And that's the risk you're dealing with when you buy hyper crowded, expensive stocks.
Nick?
Yeah, no, I agree with that, but I'll offer up two. One is that crowded part of the market. If these mega cap tech companies realize their investments in artificial intelligence aren't stacking up and cut back, that flows down the whole ecosystem and probably will take the edge or the exuberance out of the market. And then secondly is there's a growing consensus globally that inflation is under control. It's dead and buried. We're going to get rate cuts. And for whatever reason, if that's not the case, and we've got to remember they thought this in the early 70s as well, that it was under control, and it wasn't. And lots of contracts around the world are linked to CPI, and some of those haven't actually kicked over yet. You can see that in Australia with some of the pay deals with public sector workers and those things at the moment. So that would be the second one. So if inflation was higher than expected, and we don't get those rate cuts,
right? Yeah, that's good.
I might offer something more specific because I feel Nick kind of stole the thunder there.
No, he just made your answer look really bad.
So I've got to give another one out. Look, one thing I'm genuinely concerned about is budget positions around the world. The American fiscal position is dire. It is dire, and I don't think markets are pricing that appropriately. In Australia, we've got a structural deficit at a time we've got maximum employment and relatively high economic growth. That is a disaster waiting to happen. And I think watch the bond markets, watch those interest rates. It's curious to me that the Fed has cut rates a couple of months ago, and bond yields are rising in the US. That is a massive warning sign.
Yeah.
And when you're looking for concern, the bond market is far more conservative and I think long-term thinking than the equity markets are. So that's the place to pay attention.
Yeah, that's a good idea. That is a good answer.
Take that, Nick.
Yeah, take that, Nick. I have, who knows where this might come from, but it's good. I think it's often good to go and look at things like the things that you two have mentioned where hang on, this is all good news. The US has got full employment, rates are coming down, companies are increasing their earnings. I mean, there's been an incredible increase in the bottom third. Like real wages in the US have grown 16% between 2019 and 2023. It's an incredible result. Most of the benefits of that period have actually flowed to the bottom third of the income distribution, unlike here where real wages have gone backward for most people. But here's a stat I think that might sort of signify some of the problems that you don't get to hear about. So last year, the first 3 quarters of last year, credit card companies wrote off $56 billion in bad debt. That's a 50% increase on the same period in 2023. So high-income households are fine, but the bottom third of the US consumers are completely tapped out. And you can look at the US economy and say, well, it's going really well, but it's really only firing on one cylinder, but it's the one with all the money. It's things like that the way you can see problems occurring. And you can probably find 10 or 20 stats like that, I'd say.
Yeah, a lot of these warning signs are being ignored, I feel. And the aggregate numbers actually all look quite good. But beneath that, there are things to worry about. I mean, I'm not naturally a worrier. I think you make more money being optimistic generally. But when everyone else is really optimistic, and that's what I'm seeing. I mean, this Trump coin, Melania coin thing, this is the ultimate warning sign. This is the top of the market style stuff, really. And there's a lot more crazy stories like that, and that's worrying.
Yeah. We're going to see a lot more corruption, I think, over the next few years.
That's also a top of the market style sign. Yeah. The one thing that's missing, I would say, is IPOs. Generally, I mean, all the signs for top of the market are now appearing, and they're appearing simultaneously. But you're not seeing crappy IPOs. That's the one thing missing. So keep an eye out.
Do you think there are other ways of that enthusiasm being expressed, though? Like you could start a meme coin rather than
and private
an IPO. You can
private
do
credit
the
markets,
backdoor listings, private credit.
Yeah, they've gone bonkers as well.
Yeah, what were those things that they had? Like those vehicles for backdoor listings?
SPACs.
SPACs. Yeah, there were SPACs as well. There's other ways of doing it. Like IPOs have got this really tight sort of regulatory environment. They're expensive to do. You tell all your competitors what your plans are and what your financials are. There's a lot of it. If you've got alternatives to it, then I think you probably take it because IPOs are a bit of a nightmare. Yeah,
no, but historically, a raft of crappy IPOs has been a big warning sign, and we just haven't seen that. But as you say, that could be a specific reason why it hasn't happened this time.
So on that optimistic note, I think we will end the podcast. It's been fun, and hopefully it's been useful as well to our listeners. We'll be back in 2 weeks' time with another scintillating episode of Stock Take. In the meantime, thank you, Gaurav, and thank you, Nick.